GM. Today's lesson, I'm going to talk about patterns. Pattern recognition is a concept that I think is misunderstood, and also correlation and causation are two concepts that are often misunderstood as well in terms of predicting and recognizing and noticing patterns. So when most people hear pattern recognition, they'll think that it involves identifying specific price trends on a chart that can indicate a future price movement. So the obvious one is like a chart pattern, okay? Head and shoulders, a double top, or whatever. And then the other part, which is very, very, very common in crypto, is a fractal. And I share these as well. Everyone does it. You can definitely gain insights from past price action to see how the current price may match or look similar. But it's important to remember that this is not the type of pattern recognition that you should seek to employ as a trader in your systems. So let me give an example. If you see that price is moving in a certain direction, let's say Bitcoin has been in an uptrend and then it pulls back and then it goes sideways and then it tries to go lower and then it fails to go lower, it bounces back inside. So it goes below a range, false breakout, comes back inside, and then you see in the past on the chart another period of price action where it looks similar. And then your brain automatically thinks, oh, Bitcoin has done this before, therefore it might do it again. And so the right move is to get long if the previous price pattern went long or went up, right? But the problem with that is, of course, that it's a tiny sample set. It's just one example. And even if you could find 3 or 4 examples in the past where Bitcoin did that same type of price action, it would not indicate anywhere near a reliable probability of the same thing happening again. So when you first start trading, you're prone to what's known as apophenia. Apophenia is the tendency for the human brain to see patterns in things where they may not necessarily exist. Right? The most obvious of this in the market is, oh, I've seen this before. It's just that exact, if you ever get that exact feeling when you go through the charts, you're like, I've seen this setup before. Maybe it's a bull flag. Oh, I've seen a bull flag before. The last time I saw a bull flag on Bitcoin, it broke out to the upside, so I should get long. But that's not rigorously tested. So if you're talking chart patterns, the correct way is to stress test them rigorously. Now, you can take out the the false pattern recognition by doing a rigorous test. So what does that mean? If you look at a bull flag on a chart and you think that means it goes up, that's obviously not proper trading, that's not systematic, and it's not going to give you any type of edge long term. But if you look at the bull flag and say, I want to know what happens when bull flags form on the daily chart of Bitcoin or the 4-hour chart of Bitcoin or whatever time frame you're on, and then you go and back test that 100 times, then you have actual data. You can say, the last 100 times there was a bull flag on the 4-hour chart of Bitcoin, it proceeded to go up and break out to the upside X number of times, and it proceeded to go down and go to the downside and go lower Y number of times. And then you can compare how many times it works with how many times it doesn't work, and you can make an estimation for the future. That's still not guaranteed to work at that same rate in the future, right? If you know that 60 out of 100, so 60 out of 100, 60% of bull flags on the 4-hour chart break out bullish to the upside, you can then reasonably estimate in the future that there could be positive expectancy in trading bull flags on the 4-hour. It doesn't mean that every time you do it, you have a 60% chance of it winning. It doesn't mean that the next 100 would be 60%, but it's better than just seeing one and then expecting it to play out, right? So you can take basic chart patterns or candlestick patterns or moving average or technical indicators, right? You know, if you see, for example, again, these are all things I want to help you to avoid because these are traps I fell into when I first started trading. Something like you're analyzing the chart now, and the thing we're doing is we're always trying to analyze the chart right now because we want to know where the market's going next, and we want to predict it so we can make money. Right? That's the natural tendency of what you want to do. So you might open up the chart and put on the RSI. You're looking at Bitcoin on the daily chart, and you might see on the RSI, oh, wow, Bitcoin has done a bullish divergence on the RSI on the daily, and therefore it's a bullish divergence, right? So I should get long because that means it's likely to go up. But if you've just opened the chart and looked at that and seen that, again, your brain is risking that apophenia, where you're seeing a pattern that may not actually exist or may not have a positive expectancy. Of course it exists, it's there. There is a bull div on the daily chart if you're looking at it, in that context. But it doesn't mean that you know now where the market's going to go. And you can take away that subjectivity by testing it. Find the last 100 or 50 or whatever. Generally, as many as you can, right? The higher the sample set, right? The more times you can test it, the more accurate your estimation will be. But to go beyond this, right? Because I believe that spotting chart or indicator patterns will lead to bias, like I said. And the correct way to envision or imagine pattern recognition as a trader is in a broader sense. And for this, you want to look at it through the lens of how professionals would do it, and even how quantitative traders would do it. So pattern recognition is really spotting anomalies in data. Right? You're looking at data. That could be charts, that could be open interest, that could be volume, that could be the RSI, it could be CVD, funding rates, it could be the ETF flows, it could be global liquidity, it could be any data, it could be on-chain data, it could be any data that you want to study. There's endless data if you want to study it. But the way you turn it into a robust framework is essentially by looking at the data. And you want to essentially do data mining, which is where you're trying to find specific features. That could be price, could be volume, could be open interest, whatever the features are that you're going to study. And then you want to develop a framework for what they mean. And then you want to find anomalies. Anomalies is the key word. You want to find things in the data that stand out as being different to what you would expect. And then over time, after looking at tens or dozens, hundreds of them, you can see when this particular anomaly arises, the outcome is more likely to be X, right? So when you see open interest doing X and you see price doing Y, over the last 100 times I've studied this, it's more likely that price actually goes down. That type of analysis is leading you much more to a true pattern, right, that could actually have some predictive edge versus something that is just more random and prone to bias, right? The way that, the way that quants do this, like the way that big high frequency funds or trading firms that have sophisticated algorithms would do it, is they do this with machine learning generally, right? So they will use large data sets. So they will find the entire volume history for Bitcoin. Okay, so they will take the volume history for Bitcoin in its entire existence, every single daily volume print for BTC across the entire existence of it, and they will crunch that and run it through, a complex computer program to find any anomalies. Those anomalies could be, again, it could be anything. They'll use things like regression, clustering, and other, sophisticated methods to find edge or potential edge or anomalies in the data. Now, when you're starting out trading, and especially if you don't have a data science background or a, mathematical background or a background in computer science or whatever, you're not going to be naturally able to crunch and code and do all of this at once. So as a manual trader who is learning how to trade on the charts, you have to apply the same mindset, right, the same logic that they do, except without all the sophisticated architecture that they would have. So the next most important thing you want to do there is you want to focus on cause and effect, and specifically related to what is causal and what is just a correlation. I think this is probably the most important thing for a manual, beginner trader and obviously developing trader. But anyone who trades manually, trades price action, who analyzes the data themselves, you must learn to think about correlation versus causation. So, if you don't know, obviously, correlation is when two variables, 2 points of data, move together in some way. Right? So the easiest example is when Bitcoin goes up, Ethereum tends to go up too. Okay? And you can see this as well. You'll know this from altcoins. When Bitcoin goes up, altcoins tend to go up. That's a correlation. Okay? The correlation is when one goes up, it seems like almost always so does the other one. That shows a statistical relationship, but it doesn't imply that one causes the other to move. Right? You don't have a way of knowing if one causes the other or which one causes the effect on the other. You know there's a correlation. Another example of this, which is probably even more clearly visible, is Bitcoin and tech stocks like the Nasdaq. If you look on most days, if the Nasdaq is going up, so is Bitcoin. If the Nasdaq's going down, so is Bitcoin, especially during the New York session, right? The main US trading hours. But again, is there a causal link there, right? Does the Nasdaq going up actually cause Bitcoin to go up? Or does Bitcoin going up cause the Nasdaq to go up? It's not possible to know. What that is a correlation. And correlations don't tend to give you very predictive, edge. Correlation is essentially beta, so it's not going to generate edge. It's like, if this happens, the other thing should happen, and therefore, if the Nasdaq's going up, so too should Bitcoin, but Bitcoin's probably more volatile, so you can get long Bitcoin because of the beta effect. And if that correlation holds, you'll make money on Bitcoin going up. But it's not getting to the root of what causes it. If you can get to the root of what causes something to happen, that's where you can have alpha, edge, right? Alpha and edge are the same thing in this context. So causal patterns, and this can be in all the data, in the charts or whatever, causal patterns, they indicate that one variable directly results in the change of another. This is cause and effect, right? Not cause and effect in terms of the Wyckoff theory. That's a different thing. Although it is also true, the way a consolidation works, it is the cause that's building the effect that comes. But I'm talking on a specific basis. This could be on a intraday basis. This could be, you could employ this on a scalping strategy or a swing trading strategy, any type of strategy. It's getting to the root of what actually causes something to happen. Okay? So this is about it's direct influence. And if you're able to find what this is when you have truly found edge. This is when you can actually predict what is going to happen with a very high degree of certainty. Nothing's ever 100%, of course. And the way this happens with the professional quant type of actors is, again, it's deep analysis, and they will do controlled experiments. They will use complex statistical methods to do it. But again, for you as a manual trader trading yourself, you want to understand how to do this, how to find it, and how to identify them in future. So an example that I could give, this isn't crypto, but one of the clearest examples of cause and effect is with interest rates and bond prices. Because interest rates and bond prices are directly connected. If interest rates change, bond prices will change. Right? You can go and read up on this yourself if you want to understand the mechanism behind it. But in a very simple sense, if interest rates change, it will change the price of a bond. Okay? So if the Fed raise interest rates, that will affect the price of bonds. It will. It is causal because they are directly linked in that way, and it is a cause and effect relationship between the interest rate and the bond price. Another way of looking at it, more related to crypto, would be something like Bitcoin with the ETF flows. Okay, so if you have positive ETF flows, it will be the cause that creates an effect on the price of Bitcoin, especially when you have ETF flows that are above the natural issuance of BTC, meaning every day right now, Bitcoin has about $30 million of new coins that get mined that people can sell, the miners sell, right? So if you have hundreds of millions in ETF flows that are reported, and you can see them, and they're reported at the end of each day, you know that that amount of Bitcoin must be bought on the open market, generally within 1 or 2 days, and that would lead to a direct effect on the price. Now, it doesn't tell you how far price will go. It's not like saying because there's $200 million of net inflows into ETFs that Bitcoin's price is going to go up 2%. You can actually model this yourself, though. You can model each and go and look at every day of the ETF flows, and you can track T+1 is the way you should do it, right? So you should look at the following day, because on Monday, if there's 200 mil of ETF flows, that doesn't mean that the price should move on Monday, because they have to settle it a day later. So you would look at, on Tuesday, is there a price movement in BTC, and how does that correspond to previous price movements on days that have similar ETF flows or different? But the point is, you know for sure, because it's one of the only publicly available pieces of data that we have, you know for sure that there was $200 million of net inflows. So that was new issuance of shares. That means $200 million of Bitcoin must be bought, right? Because it's new. And you can then imply that the cause, the buying of ETFs, the new inflows, will create an effect on the price of Bitcoin, which should be up. It should be a positive price appreciation. Now, because markets are not perfect, that doesn't always tell the full story, because of course, somebody could come in and decide to sell 200 million of Bitcoin, some whale themselves, that same day and offset it, right? You don't know that. You don't know for certain, but you're getting to a point where it is much more causal and not so much just a correlation. So that's really important, because correlations show a relationship statistically, but causals demonstrate a direct effect. So that's what you're looking for. So when we talk about pattern recognition, and if this is confusing to you, don't worry, especially if you're in white belt or you're starting on your journey. This is more like where you should be seeking to get to in the future. You will always start as a trader by looking at basic patterns and spotting them on the chart, and that's good. Pattern recognition is something that you start off and then you build it over time. But the end goal should be to be able to apply your pattern recognition abilities to actual events that you can get as close to identifying a true cause for what happens, right? And I think that's it. I think that's pretty much what I want to say. This, by the way, it'll be like this sort of a preview to a lesson I will do very soon about pattern recognition, cause and effect, correlation versus causation, and how you can use it for things like price, volume, open interest, and other technical factors that we can analyze on the charts. So keep an eye out for that one. And in the meantime, I want you to think deeply about what pattern recognition means beyond just seeing candlesticks on the chart or seeing an RSI divergence or whatever it may be.